Welcome to part two of my discussion with co-author John Rubino. In this episode, we will discuss how and why nations are moving away from the dollar, and most importantly, how this will affect the citizens in the United States of America. I hope you enjoy.
That was a great explanation. Let's get to some global economics and things going on globally surrounding the dollar and our current economy. Now, I came across a term last year which really sparked more of an interest to dig deeper. It was de-dollarization. What is de-dollarization, and how are there some what are the events now that's instigating it and really driving it?
That's a good one. To understand this concept, you have to go back to why the dollar is the world's most important currency to begin with. And that is true for a couple of reasons. First of all, after World War II, we were the only entity left standing that had any power of any kind. So everybody wanted dollars because we were the strongest economy, therefore our currency was the most desirable. And then in the 1950s, we cut a deal with Saudi Arabia, basically, that said that we'll protect them from everybody else. They're this little tiny, 5 million people in the middle of a sea of much bigger countries who don't like them and want their oil well. And so they needed protection in there from their own point of view. And so we promised to protect them as long as they only accepted dollars in return for oil. So that made the dollar, they call it the petrodollar. That made the dollar by far the most important currency in the world. Everybody has to have dollars if they're going to buy oil, and everybody has to buy oil. So the dollar ever since has been the safe asset that you hold when you need to protect your capital and you don't want it to go down in value. You buy dollars, you buy government bonds, so ever since, the dollar has been the world's most powerful currency, but that has given us, again, a huge amount of power, which we proceeded to abuse. We basically borrow hundreds of billions of dollars a year to finance the biggest, most powerful military empire the world has ever seen. And we use that military empire to bully everybody else in the world. We push, of course, we invade everybody in the Middle East. Anytime we feel like it, we just go in and take over Iran or Iraq or now Yemen. It doesn't matter. We'll invade you if you cross us. Yeah. And then we push around China and Russia too, and along with the rest of the developing world. And they don't like that. They feel like they should be powers, at least in their own neighborhood. And so these guys are so fed up with us that they're doing things to allow them to function without dollars. In other words, Russia and China, for instance, are cutting deals where Russia ships natural gas to China and China pays Russia in Chinese currency, the yuan. And so they bypass the dollar to do that. And lots of other developing world countries are doing the same thing in different ways. And so the net effect of that is to begin the process of moving the dollar out of the center of the global financial system. I mean, it's a long process. It'll take a while. But these guys are serious about it, and they're taking a lot of different steps in order to be able to use their own currencies for international trade and for savings and just totally bypass the dollar. Now, here's what happens when that really gets going, because most of the world's central banks, for instance, keep things called reserves, which is basically their savings. That's their bank account, basically, that they use to back their currency. It's the money that they use for emergencies and to show the world that they've got a ton of liquid assets. If there's a run on their currency, they can stop it by using some of their savings, okay? And most of that is in dollars. About 60% is in dollars. But if they can use other currencies for trade and for savings, then they really don't need as many dollars. So maybe the proportion of dollars in central bank reserves drop from the current 60-something to 50-something and 40-something over the next period of years. And what happens then? That means they have to sell those dollars in order to buy rubles and euros and yen and yuan. And that puts downward pressure on the value of the dollar. And so this is a really dangerous thing from US policy point of view, because once that perception takes hold that you really don't need dollars, you can get by just fine without them, and everybody's basically pissed at the US to begin with. I mean, they're really mad at us. And they are happy to see us fail. So once that gets going, you've got a double incentive. You really don't need dollars. You can get by with your own currency now by doing currency swaps with other countries that you trade with. And you'd like to see us fail to begin with. That's a lot of incentive to get this thing really going and just dump dollars whenever you get the chance. And that's going to be very hard for us to deal with, because for the value of the dollar to fall dramatically on international markets means we lose this huge privilege that we have. You know, how do we finance a $1 trillion a year global military empire if people don't want our currency anymore? You know, if they won't buy our government bonds? How do we then, you know, concurrently finance a cradle to grave entitlement state that we're building here too? And if we can't borrow money overseas, or we can't borrow it as easily, our interest rates would go up. And see, when our interest rates go up, that means all of our existing debt gets more expensive, because we have to roll over our debt. You know, when a bond issue comes due, we don't just extinguish it. You know, we don't let it just disappear. We have to refinance it in the U.S. In other words, we have to borrow more money to pay off the debt that's coming due. But if we have to borrow at a higher and higher interest rate in order to pay off our debt that's coming due, that means our costs go up. And so that starts this kind of death spiral where every time some debt comes due, we have to refinance it at a higher and higher rate. And that means our government interest costs go up, which means we have to borrow even more to pay our bills, which means we have to pay even higher interest rates. And that's the kind of thing that terrifies fiat currency governments, because that's something you can't get out of once it starts. Yeah. And that's out there in our future somewhere. And the question is, at what point does it really get going? And you know, I would have guessed 2006, you know, back in the day. So it's taking way longer than I would have thought possible, which means that I have no idea when it actually gets going, because this is an unnatural world right now. Right. And if it can be unnatural today, it could be unnatural for 10 more years, who knows? But it's out there. I mean, I think there are some basic laws of finance that you can bend but not break. And this is one of them, that a government can't borrow unlimited amounts of money. Right. So you know, there's a point at which you have to stop borrowing. And so we'll hit that point somewhere, someday. And it'll be a catastrophe when it does.
Wow. So it seems like, you know, with all that information there about what's transpiring with the intergovernment, you know, currency swaps and things like that, you know, and not having a time frame as to when it will come to an end, it kind of seems like now with all those organizations such as the AIIB, the BRICS, and the EAU, all of those things are becoming mainstream now. Like I first heard about the BRICS, you know, being mentioned a couple of years ago, but now they're beginning with the development bank, and all these things are speeding up. So it seems like, you know, we're drawing near, and it might be that time any minute now that they're setting things up.
Yeah, I mean, there's a lot of really visible stuff happening now. They're setting up parallel institutions in the developing world that compete with these big international banking institutions that the U.S. runs right now, like the World Bank and the IMF. And the idea is that they can set these things up, fund them with their own currency, run them the way they want them to be run, and not even have to answer to us at all. And that drives us crazy. Like the U.S. government has been adamantly opposing the Asian Development Bank that's being created right now, and it's been losing big time. Everybody's just ignoring us and joining this big bank because they want to be partners with China. Right. You know, China is perceived to be the rising power in the world, and so they want to be on China's good side. They want to get a cut of these deals when roads and airports and new cities get built in Asia. And that's leaving us on the sidelines, and we're trying to decide what to do about it now. I mean, we could join this bank and be a junior partner, which the U.S. would hate, or we can stand outside of it and stand there with our arms crossed and just try to ignore it while it's doing all this cool stuff with money that is not our money, you know. And so it's kind of a no-win situation for us. We can't stop this from happening, but we don't want it to happen, and so we just have to kind of figure out how to deal with it as best we can. And it's just the beginning. There's a lot of other things that the developing world can do to diversify away from dollars, and they're actively looking at stuff like that. You know, China and Russia are buying gold like crazy, right. And the assumption is that they recognize that gold has been the real money of humanity for 3,000 years, and that this little interlude of fiat currencies since 1971 is an aberration. and that at some point we're going to go back to some kind of a commodity-based money standard where a government can only create as much new money as it has, or as much new currency as it has actual money sitting in its vaults. That limits the supply of money or currency that exists out in the world. And governments hate that on the one hand because it limits their power. But to the extent that it limits the dollar's power, it might be worth it for some other countries to go that route because they gain in relative terms, even if they lose some printing press power. Right. And that seems to be what China and Russia are doing right now. They're aggressively buying gold. They're snarking up all the gold that is produced by the world's gold miners every year right now. And so that leaves the rest of the world, if anybody else wants gold out there, they have to buy it from an existing source. And it looks like that existing source is Western central banks. We are dumb enough in the West to sell our gold to China and India and Russia when we have only a limited amount of gold, you know? And so at some point, this is another limiting kind of trend where we hit a wall and we don't have any more gold left. Or we don't have any more that we can justify selling. And then what happens? You know, these guys still want gold, but we don't have any more to sell them. And the price probably has to soar at that point to reflect the falling supply and the still strong demand. And so at that point, you see this huge surge in the price of gold because we all recognize that it's in shortage. And it's crucial to understand what that means because gold, think of it as a form of money. And if it goes up in value versus the dollar, that really means the dollar is going down in value. So a soaring price of gold means a plunging value of the dollar. And that's another thing we hate the idea of. You know, we're terrified of the world recognizing that this is all a scam, you know, that fiat currency is just this make-believe thing that governments thought up in order to have more power over people. And a soaring price of gold illustrates that in a really certain way for most of the world. So we hate that. And but supply demand says it's going to happen at some point in the not too distant future.
Right. When I saw that billboard, I guess near the airport in China with the renminbi, it said world currency, and had a gold coin in between someone's fingers. I'm like, wow, that's pretty bold. They're preparing, and obviously the fact that they're encouraging their citizens to buy gold, you know, is an indication for them that something's happening within their lifetime. So, but that's stuff we won't hear about on mainstream media here.
Think of the difference between here and there. And that government is actively encouraging its citizens to buy gold.
Right.
And we, in the U.S., we do everything we can to discourage that because we see that as competition for our currency. Yeah. China obviously sees it in a different way. They see it as a backing for their currency, you know, something that gives their currency value. If they've got a lot of gold, then we can trust their currency because we know that they have lots of money backing it up. Right. And so, and historically, that's the correct point of view. You know, up until very recently, up until my lifetime, and probably not much more than your lifetime, that's how everybody thought. Going back for 3,000 years, that was normal. That was the normal way of looking at money and currency. And so it's only lately that has changed. And I think China, with their 3,000-year perspective, sees that, and they see that history is going to revert to normal at some point, and they want to be on the right side of that reversion.
Okay, now let's take a little closer to home here on the motherland. Economic recovery. Everywhere you turn, every news syndicate, everybody says we're in an economic recovery. Are we? What's your status on that?
Well, the basic thing to understand about debt is that when you borrow too much money, life gets harder. And that's true for individuals and families and for governments. And so we've borrowed huge amounts of money over the last 30, 40 years. And so now it's harder to grow if you're an economy. You can't, if you're the US or Europe or Japan, you owe so much money already that it's hard to get people to borrow more money and buy more stuff because they're already maxed out. You know, how many people want to take out a home mortgage now? Because most people already own their house. You know, they've already taken out their mortgage. Lots of people taking out car loans. There just aren't that many more people to buy cars now. So we're having to work our way down to subprime car loans. You know, we're making the equivalent of subprime mortgages to people to buy cars now because we can't get them to buy cars any other way except by going to really bad credits. You know, people who shouldn't be borrowing in the first place, we'll give them a deal, let them buy a car. And that's still not really working.
I
Go
hear
ahead
that.
if you have a.
No, I hear they're coming up with a new what's the score? A way to score your credit score now
Yes,
to
yeah.
suit those that are below, I guess, the 620 range. So now, that when they come out with that, everyone will really qualify for whatever they want because, credit is, is free.
Now it's whatever we want it to be. See, that's what happens at the peaks of markets. That's how you know you're in a bubble. One way is that the old business practices that were tried and true and were in place because they worked get tossed aside in favor of innovations that let you get the deal done. So back in the 1990s, people stopped looking at earnings for companies and they started looking at eyeballs. And that way you could justify buying tech stocks. And then in the 2000s, people stopped looking at the ability to pay when they were taking out mortgages, and they just started looking at, well, the value of the house is going to go up by 10% a year, so we'll lend you, even if you don't have an income, we'll give you a home mortgage because the value of the house is going to go up. And that's not normally how home mortgages are written. And so now, if your credit score is not high enough, we will rewrite the terms of credit scoring to make your credit score look higher so we can give you money. And that's another sign that we're at the peak of a cycle and that bad stuff is going to happen. But anyhow, to get back to the recovery idea, we're growing way more slowly around the world than we would be normally, with interest rates way down and governments borrowing huge amounts of money and all the rest of the stuff that's going on. 20 or 30 years ago, zero interest rates and 3.5% mortgages would have ignited a rip-roaring boom. We would have had the fastest economic growth on record, and it would have been destabilizing. But we would have responded to those rates in that way by borrowing huge amounts of money and spending it. Well, that's not happening now because we've borrowed so much money that even 0% interest rates, even if they give you free money, you don't necessarily want it because you got to pay it off eventually, and you can't pay your credit debts. So what do? You pay off debt instead of taking on new debt. And so the world isn't growing very fast.
Right.
And governments can't figure out why, because they have this model. There's an economic model called Keynesianism that doesn't look at how much people owe. They ignore that, and they just look at the factors like interest rates and government spending and stuff like that. And they say, well, all right, the government's spending a lot of money. Interest rates are really low. We should be booming. Why aren't we booming? And the answer is because we've already borrowed so much money that nobody wants to borrow anymore. But because that's not part of their framework of analysis, it confuses them. They don't understand why this is happening. But anyhow, yeah, the world is growing very slowly to the extent that it's growing at all. And in some places, we're dropping back into recession. And the U.S. is one of those places. We've had some really slow, low, depressing numbers come out lately that implies that we might not even be in a recovery anymore. And so then what happens if you drop into a recession when your normal tools for fixing a recession is lower interest rates and more government spending? If the government has already doubled its debt in the last 5 years and interest rates are already at zero, what do you do then? That's the big question for these guys.
You NERP. You go to
go to
NERP.
negative interest rates. And that's happening. Switzerland today just issued 10-year bonds at negative interest rate, which means if you want to lend money to the Swiss government, you have to pay them for the privilege of lending them money. So your investment in Swiss francs, the Swiss government, that gets less valuable year after year after year in Swiss francs. And people are doing it. They have nowhere else to put their money, so they might as well put it in a bond where they're pretty sure they'll get paid eventually, even though they'll get paid less than they put in. And that's, from an intuitive standpoint, crazy. And from an economic theory standpoint, also crazy. I mean, it shouldn't be able to happen because why in the world would you give money to the Swiss central bank or the Swiss government if they're going to give you less money back when you could just take that money, put it under your mattress, and have it be the same number of Swiss francs this year as next year and 10 years from now? And yet people do it. And so there's a lot of economic theory that has to be revised here because the world's behaving in ways that shouldn't happen. And as you said, when we have the next recession, governments have no choice but to go to really negative interest rates. They got to push things down to wherever the limit is. There's some limit where if interest rates are so negative that it just doesn't work anymore and the global financial system just freaks out. And we don't know what that is now because they used to think it was zero, but it's not zero because we're still functioning with negative interest rates. So Now what? We've got to find that limit, but we don't know what the limit is. It might be 2%, might be 4%, but at some point we're going to push things to the limit, and then the system will just go crazy. The system will break down, and nobody knows where that is because nobody thought we could get this far. So yeah, this is a crazy time where the experts have no idea what they're doing and no idea what's going to happen next because their models have stopped working. So this is arguably the craziest financial period in human history that we're living through right now, and that's not a good thing. That's not going to be fun.
They're clearly experimenting with our lives. I mean, they're experimenting with our futures, with our kids' lives. I mean, just the fact that our debt is so huge that it could never be repaid just goes to show that there's no concern about the here and now. Everything's being pushed off.
This is all money we're borrowing from our kids.
Right, exactly. So that's another thing that concerns me as a father. I have young boys that, I don't want them to grow up even more indebted than I'm growing up, and I got it pretty good.
Your kids already owe a couple $100,000 a piece.
Right. Yeah. Right.
And they don't know. That's before their credit cards, before their future mortgages and their student loans. They just owe a couple $100,000 already. Yeah.
Right.
So
when they received their Social Security card, it came with a debt tag to it. It came with a receipt. Now, with that being the case, subprime lending is at all-time highs for different areas now. Debt is through the roof. The world, for the most part, is beginning to shift and turn their back against us. That's what it seems like. How does that really come home to our personal economy, to your personal economy, to my personal economy within my home? The cost of living, standard of living.
Yeah, it means at some point the dollar has to get less and less valuable because the only final solution to this is to do something called devaluing. So basically, if you owe $1 million, you got to pay $1 million to somebody at some point plus interest. But if you make the dollar worth only half of what it was when you took out that loan, then in effect you only owe $500,000 because you're paying that money back, paying that loan back in less valuable currency. And so that's what the governments of the world are going to have to do really aggressively pretty soon. They're going to have to make their currencies less valuable. And so to the extent that you own some, you get hit. If you've got $10,000 in the bank, it's going to be worth only $5,000. It'll still say $10,000 on your bank account, but you'll only be able to buy what today is $5,000 worth of stuff with it. So savers lose big in what's coming. Anybody who just puts money away and does what they're supposed to do, follows the rules, save a little bit out of each paycheck, they're the victims of this. And at the same time, companies don't want to hire people in these circumstances because the world gets more and more uncertain. When the money that they are taking in gets less and less valuable year after year, they can't predict what's going to happen in the future, so they get cautious. So there are fewer and fewer good jobs out there, which is what we're seeing now. It's really hard to get a good job now. It's easy to go to McDonald's and get hired. And when we see, unemployment is down to 5.5%, that's basically what they're talking about, is a lot of people got hired as waiters and waitresses and corporate temps and things like that, jobs that nobody thinks of as a real job. It's just something you kind of sort of pay the bills with while you're waiting for your career to take off. Right. And that's our society now. And it's only going to get worse because capitalism requires certainty about the future. If you're going to build a factory or build an office building or start a new company that requires 50 people to run, you need to have some sense that the returns you get on that investment are going to be predictable. And if they're not predictable, you're not going to do it, or you're going to be less likely to do it, because you can't know for certain what's going to happen with your investment. And so that's what happens in capitalism when things get uncertain and volatile, is companies just don't invest as much in the future. Entrepreneurs don't start new companies. They stay with their current jobs and hunker down, and small companies don't expand, and it goes on. And the net result is fewer and fewer good jobs for people. And so that's the conditions that we're creating. And again, this should be no surprise. This is exactly what you would think would follow from giving the government a printing press, because you get instability from these bureaucrats and elected officials having that kind of power. And that instability leads to companies being more and more cautious about expanding. So what's happening right now in the stock market is that big companies have a lot of cash. They can borrow very cheaply because interest rates are so low, and they're doing it. They're borrowing lots of money. But instead of building new factories and hiring new people, They're just using that money to buy back their stock on the open market and push up their share prices, because that's how the guys running the companies get paid. If their stock goes up, they make more money. And so we're not building productive capacity. We're not hiring new people. We're just borrowing tons of money and pushing up the stock price so the corporate executives can get bigger year-end bonuses. And that's, from their point of view, it's logical, because they know exactly what they get if they push up their stock price, but they have no idea what they get if they build a new factory, because the world is so uncertain. And so it's, you know, all this stuff is happening that is exactly what you would think would happen if you go back and give a government a printing press.
Right.
And that's what we need to understand, that this is the root cause of everything. Governments being in charge of the money supply is a bad thing that leads to all our current and future problems. And so if we're going to fix things, which we probably aren't before
Yeah,
it collapses,
we're past the point of fixing, probably.
Yeah, I think so too. But if we were going to try to fix things, the first thing we need to do is get at the root cause.
Right.
Take the money printing press out of government's hands, and then start over.
Now, yeah, now, you mentioned take the printing press out of the government's hands. Now, I see that. I think Switzerland and another country I can't think of, it has. Oh, Iceland, yes, has mentioned about passing some type of reform where they take the issuance of credit out of the banking sector's hands and nationalizing, I guess, the money supply back to its original source, which should be the government. And so we got about about 8 minutes left before, you know, because I want to wrap this up. I don't want to keep you all day. 8 minutes left. Couple more questions. Give me a brief rundown on what you think that's about.
Well, I think that people are trying a lot of different things, and I think Iceland has done some good stuff in the past. You know, they had a financial crisis along with everybody else in the 2000s. They put their bankers in jail.
Yeah.
They let their banks fail. They protected their depositors, and so they recovered in a more meaningful way than most other countries. So now what they're thinking about doing, and I won't pretend to be totally up on the details of this, but taking the ability to create credit out of the hands of the banks and putting it in the hands of the government is kind of, you know, taking something away from the fox and handing it to a wolf or something like that. Yeah. They both are going to get into the hen house and cause trouble. And so what you need to do is completely take the supply of money, control of the supply of money, out of the hands of people who have a vested interest in making it grow quickly. And so you do that by connecting the amount of money or amount of currency in the system to some fixed or slowly growing object or substance.
Right.
And so you do a commodity-based money supply where the commodity you're backing your money with only grows by 1 or 2% a year. And that's why gold works so well, because we have to get gold out of the ground, and we've historically done so at like 1 or 2% a year. So the money supply in the classical gold standard grew about the same rate as human population, which means it stayed about as rare as it always was, and so it held its value. And so you need to do something like that. I'm not saying the gold standard is the only way to do it, but it's one way that is shown to work in the past. And that's a huge conceptual leap. Governments don't want to do it. People don't understand it. They think it's this really primitive idea. But really what it is an understanding of human nature that accepts that we are corruptible and tries to set up a system that keeps us from being easily corrupted. That's what the original design of the US government was, a division of power so that no one group could get more powerful than the others. And in that way, hopefully the government itself stayed fairly small and let individuals do their own thing. Well, the money supply is a crucial part of that process. We have to find a way to fix or limit the growth of the amount of currency in the system, the amount of money in the system, and in that way limit the power of government to mess with us. So that's the key to everything. And I think the Iceland thing is, it doesn't sound like that's the solution. As long as some human being is in charge of the amount of currency that's being created, that human being will be corrupted by that power, you know, one way or another.
Sounds good. Well, we got about 4 minutes left. And briefly, I want to give you a chance to discuss the money bubble, dollarcollapse.com, things you have going on, and how can people improve their monetary literacy? I mean, Rethinking the Dollar is designed to help people, you know, educate people. So I have books and stuff listed there, things I want to share. you know, 3.5 minutes. Give me your take and give me a little bit of information about money bubble and dollar
Sure.
collapse.
Well, see, luckily now, this has been going on for a long time. The whole gloom and doom, sound money side of the literary world has been around for 15 or 20 years because this stuff has been obvious to people who are obsessed with it and who pay attention to it. And so there are a lot of good books out there that you can get that will bring you up to speed in a hurry. And I've written a couple with that goal. The one is called The Collapse of the Dollar and How to Profit from It, and another is called The Money Bubble. Either of those has a lot of background information that explains terms and gives you some background that allows you to understand what's going on. And meanwhile, there are tons of websites out there that are covering stuff like this. Dollarclapse.com, which I run, is one, and there are literally dozens of others. So once you get into this world, you find out that it's a pretty rich environment with background information and current commentary and everything. So you spend a couple of months doing this. Read a couple of decent books on current monetary policy and the financial world, and then start visiting some websites. Find a couple that you like, visit them daily, read the stuff that they put up, and in a few months you'll get this. You'll know what the terms mean. You'll understand when the Federal Reserve makes an announcement. You'll know how they're lying to you, and when the presidential debates happen again, as unfortunately they're going to happen again really soon, you'll see what political hacks these guys are and how they're just making stuff up out of thin air, and you'll be able to see through it. And by the way, you'll love a guy named Ron Paul.
I saw he announced himself yesterday, and that's the best out of the whole pot of everything. So
well, that's Rand Paul. That's the son of
Rand
Ron Paul. And so they're keeping it in the family. They're the really interesting libertarian politicians out there who say a lot of this stuff, but on a national forum. Not very many people have the guts to say it and can get away with saying it in public life, but these guys seem to be able to do it.
Yeah, interesting. Well, Mr. Rubino, I thank you for your time. Definitely, I've learned some things. I know those that will hear this will definitely get a chance to learn some things, and look forward to hopefully keeping in touch with you. And I definitely will be, tuning into your other commentaries because you're a well-wanted man. See you all the time on the internet, so I appreciate you taking time with me. Other than that, any last words?
No, I think we've covered it, Mike. I enjoyed our talk and look forward to the next one.
Thank you. Appreciate it. Have a good one.
Take care.
Well, this concludes my interview with co-author of The Money Bubble, John Rubino. I hope you found this to be informative as well as educational on issues surrounding the dollar. In hopes of bringing you more great interviews, I want to encourage you to subscribe to Rethinking the Dollar, as well as give me a thumbs up on Facebook, where I often share monetary news that's real relevant to issues surrounding the dollar. Look forward to seeing you in the next interview. Thanks.